Module 28 is about a new model and it has two names. It's either the money market or the liquidity preference model. It's all about money. And as you know, liquidity is the ability to turn an asset into cash or money. So, how much you prefer cash is all about money demand. You actually know quite a bit about money supply so far because all of those Federal Reserve tools, the reserve requirements, the spread with the discount rate, and open market operations are the money supply shifters. So you've actually already learned those. So in 28, we're going to talk about money demand, why the price of money is a nominal interest rate, and then we'll see how this model connects to other economic models. Money demand is all about the desire to have your assets in the form of money in your wallet instead of in the bank. So, if you remember, John Maynard Keynes is the father of macroeconomics. We talked about him before with stabilization policy and the concept that he thought we should intervene during recessions and inflationary periods because in the long run, we're all dead. Now, what he had to say about money is that people have two motives for holding money. And remember, holding money is keeping all of your wealth in the form of cash in your wallet as opposed to in the bank or tied up in investments, etc. So, the first reason people want to hold on to cash is the transactions motive. Transactions are buying goods and services, and people like to be able to have some money in their wallet. So if you ever need cash for something, you have some nearby, and you're not constantly trying to find a bank or an ATM if you have some cash in your wallet at all times. The second reason people might want to have some cash in their possession is the precautionary demand for money. And that's really all about emergencies. A lot of times people like having some money for a rainy day. So that emergency could be a flat tire, could be some sort of unexpected expense. A lot of times people have some cash in the house in case there's some sort of natural disaster or power outage. And whenever the economy is slow or there's general pessimism and fear about problems in the future, that will cause money demand to increase. If you don't trust the government or banks, you might want to hold on to more money in the form of cash and have less of the money in assets or in accounts that are harder for you to take the money out of. So we realize that it's nice to have some cash, right? It's convenient to have some of this money in your wallet in case you need to make transactions. But there's an opportunity cost to holding on to money. If you have no money in the bank, if all of it is in your possession, then you are not earning any interest on the money. So the price of money, the opportunity cost of money, is what you could be earning if you had it in the bank instead of in your wallet. So another review term is margin. Remember, margins are these marginal decisions, are these small changes. And when people are thinking about cash, they're thinking about decisions on the margin. If I had a little bit more money, would I be better or worse off? So, for example, if you ever pay with your debit card at maybe a grocery store and you swipe the card and the machine says, "Do you want cash back?" Usually people are thinking about, do I need an extra 20, 30, 40 bucks? That's a marginal decision. You're not thinking, do I need to take all of my money out of the bank? You're just thinking, do I need to take out a small amount of cash? That would be a marginal choice. Now, it's one thing to speak about opportunity costs in vague terms, in terms of, well, the opportunity cost of money is the money that you could be earning if it was in the bank. Well, we can actually figure out the specific opportunity cost. Now, looking at this table, we have a table of selected interest rates. 1 month CDs are 5.3%, savings accounts are 2.4%, holding your money in the form of currency, so taking all of it out of the bank and putting it in your wallet, you would earn 0%. So the question is, which interest rate is your opportunity cost? Remember, you have lots of trade-offs, all the things that you're not doing. So, if you decide to hold money in your wallet, you have two trade-offs. It's not in savings, it's also not locked away into a 1-month CD. But you can't have multiple things as the opportunity cost. If you recall, the opportunity cost is the best thing you're not doing. So if you have the potential to earn either 2.47% or 5.3%, the best thing is the highest interest rate. So in this case, if 1-month CDs are 5.3%, the opportunity cost of holding money in your wallet instead of in those 1-month CDs would be the 5.3% interest that you're giving up. Your money cannot be in two places at once. The money can't both be in a CD and a savings account. So the opportunity cost is the best thing you're not doing. In this case, 5.3%. So remember, CDs stand for Certificate of Deposit. And a CD is fairly illiquid because once you put your money into a CD, you can't access it during the time limit. So if it's a 12-month CD, that means that the money you deposit, in this case $100, is locked away. You can't withdraw it until the 12 months is gone. At the end of the time period, the 12 months, you would get your $100 back plus 5% interest. 5% interest on $100 is $5. If you decided to take your money out early, if it's been 11 months and you really need the cash, you can take your money out, but you will forfeit the interest. It's not like you earn 4% interest because it was in there most of the time. You earn nothing if you take it out early. So, people decide on a case-by-case basis if the opportunity cost is worth it. So, if you were not able to have $100 for a whole year, is $5 worth it to you? And that's really your choice. Some people might say yes, some people might say no. That's an individual decision. So at a 5% interest rate, I would say that most people probably would rather have their money in cash than earn $5. But what if the interest rate went up? And now the interest rate is 50%. Well, that means at the end of the 1 year, you will have earned $50 on the $100. So, if it's money you didn't need, would you be more compelled to put your money into a CD if you were going to earn $50 at the end of the year? And most people probably would. So, increasing the interest rate reduces the quantity of your cash that you feel like you need. You'd be all right letting that money go if you could. Now, what if interest rates are super low, 0.5%? So in that case, if you're only going to earn 50 cents on that $100 in profit, is it worth it to you to not be able to access your $100 for 1 year for the potential to earn 50 cents? Most people would probably say no. So as interest rates fall, your desire to hold on to your cash, your quantity that you want to hold, increases because you're not going to earn very much alternatively. So the interest rate is the opportunity cost of money. When the opportunity cost of money is higher, you don't demand your cash as much. But when the opportunity cost or interest rate of money is lower, then you demand your cash. You don't really have any incentive to have it in an illiquid asset to earn such a little amount of money. Now we have a chart looking at interest rates and how they changed. So from June 2007 to June 2008, the Great Recession started. Normally, during a time of recession, the Federal Reserve wants to lower interest rates because they want to encourage people to spend money. And you can see that all three of the columns of interest rates are lower during the recession, 2008, than they were to begin with. Now, also, you might be thinking, wait, I thought that the federal funds rate was the cheapest, the lowest interest rate in the economy. Yes, but it's the lowest interest rate that people pay. There's a difference between interest rates that you pay and interest rates that you earn. So in this case, as interest rates, short-term interest rates are falling, what's happening to the opportunity cost of money? So for federal funds rate, of course, people, that you and I, don't qualify for the federal funds rate. We could never put our money into anything and earn that. Because think about it, federal funds rate, that is the interest rate for bank-to-bank loans. So that is actually not something that we as consumers can do. But we could put our money into a 1-month CD. Would you be more likely to put your money into a CD if it was 5.3% interest or 2.5% interest? You probably would be more likely to put it in when the interest rate is higher. So in this case, the quantity of money that you demand as the interest rates are falling, you demand your cash more, right? Because the lower the interest rate, your desire to put it into the bank goes down, you might as well hold more of it in the form of cash. Same idea with savings accounts. The more money you will earn in interest in your savings account, the more money you're willing to put in the bank. As the interest rate paid to you in your savings account falls, your desire to save money in the bank falls as well. So as short-term interest rates fall, the opportunity cost of holding on to that cash is decreasing. So here's our general rule. Interest rate can be shortened to IR. The higher the short-term interest rate, and we're talking about a fund where the interest will mature in less than a year, like a CD. So the higher the interest rates, the higher the opportunity cost of holding on to money. The more money you could be earning keeping your money in some sort of illiquid investment, the less likely you want to hold on to your money in cash. But as interest rates fall, the opportunity cost of holding on to cash also falls. When you're not going to earn as much money with those types of accounts, your desire to deny yourself the convenience of holding on to that cash falls too. You can see in this political cartoon, the newspaper says interest rates to remain at all-time low, and he says we're going to have to invest in another mattress. When interest rates are low, they feel no incentive to save their money in the bank. That's why you can see they're saving all of this cash literally under their mattress. So why is the opportunity cost of money short-term interest rates? Why wouldn't we look at long-term interest rates like a 10-year CD? What's the difference? The reason why is that we only think about money demand and holding money for short-term transactions. So when you're in front of that machine and it asks you, do you want cash back? You're probably thinking, do I need any cash today or this week? Maybe even this month. But let's say you're planning on going to college one day. Would you take out cash at an ATM today because you're going to college in a year or two? No, that's silly, right? So your whole decision-making process about holding on to cash is all about short-term transactions. Nobody's withdrawing cash because they're going to need it in 10 years. That's foolish. You keep it in the bank to earn something on it. The longer the CD, the higher the interest rate. The longer they have your money, the more they have to pay you to compensate. But that's not a really fair comparable for the opportunity cost of money because money is done for short-term decision making only. Because money demand is all about short-term purchases and short-term decisions, the opportunity cost of holding money will be the nominal interest rate. Remember, we have nominal and we have real. Nominal means not adjusted, and real is adjusted for inflation. So in a number of years, yes, we will absolutely notice inflation. But if I'm taking out $20 from the ATM to use in 2 or 3 days, am I going to notice that inflation by the time I spend that cash? No. Cash is used for short-term transactions, so there's no need for us to adjust for inflation in the short term. We won't even notice it. That's why the interest rate for cash is always nominal interest rate. No need to adjust for inflation in the short term. What's interesting is that the nominal interest rate, which is shortened to NIR, that is the official abbreviation for nominal interest rate, it is the lowest interest rate in our economy. And we know that the lowest interest rate in the economy is the federal funds rate. So the nominal interest rate and the federal funds rate are sometimes used interchangeably. So sometimes people talk about money market, the price of money, in terms of what it would be in the federal funds rate. And all other interest rates are stacked above this. Now, when we label the money market model, I always want you to put NIR, nominal interest rate, as the price of money. Just pointing out that this is the base, the lowest interest rate in the economy. So let's say it's 2%. That will match up with the federal funds rate, which will also be 2%. They're the same value. Now we're starting to see the money market model written down. So it says the price is the interest rate, but we just saw which interest rate is it. The price of money is always in the nominal interest rate. So even though nominal is the default, I want you to always label it nominal interest rate. The reason why is that the next model we're going to learn, loanable funds, uses the real interest rate. So it's important to keep those things straight. So whenever you draw this, we're not going to say interest rate, we're going to specify which one. Money is the nominal interest rate. All right, so we're talking about how the price of money is the interest that you would be paying if it was in the bank as opposed to in your wallet. So we have this negative relationship. As the interest rate rises, the opportunity cost of holding money rises. So that's a move along the curve. Now, we've seen this before in other supply and demand models, that the axes themselves, especially price, is a move along the curve. So if the nominal interest rate goes up, the quantity of money demanded decreases. There's a negative relationship between interest rates and the quantity of money that you demand. For this reason, money demand, like every demand curve, is downward sloping. We know that money demand is downward sloping, but let's make it official. Nominal interest rate, NIR, is the movement along the curve. So if nominal interest rate increases, it will be a movement upward along the curve. And the quantity of money demanded goes to left, the quantity of money demand decreases. Remember that word quantity. If the entire line shifts, you would say it increased or decreased. But as we move along the curve, we talk about the quantity. If the nominal interest rate decreases, we still do 2 dots along the curve. But if the nominal interest rate decreases, the quantity of money demand goes to the right, so the quantity of money demand increases. Nominal interest rates are the non-shifter, the move along the curve for the money market model. Before we learn about the shifters of money demand, it's important to really have a clear sense of what money demand means. you want to have money. Of course, everybody wants to have money. But if that's all money demand meant, then wouldn't we always have this like unlimited increase in money demand? I want more, more, more. That's not what it means. Money demand is the desire to have some of our wealth in the form of money or cash, as opposed to something that is illiquid. So you can see that your wealth is all of the value of stuff that you own. You probably want some of your wealth to be in the form of money, but you also want some of your wealth to be maybe in stocks or bonds, or you want to buy a car or you want to pay for college. So you can use your wealth lots of ways. All money demand is how much cash do you want to be holding on hand? That's money demand. So external factors are the money demand shifters. They're called external because they're not actually part of the model. Nominal interest rate is the non-shifter and it's part of the model. It's an internal factor. External factors are other things that occur that could affect your demand for money. How much money do you want to have in your wallet or in your pocket? If your money demand goes up, the entire demand curve will shift to the right and you would just say money demand increased. So the shifters for money demand can be abbreviated to RT. A stands for the aggregate price level. As prices go up, you demand more money. If everything got cheaper, you would demand less money. You wouldn't need as much cash to pay for things. R stands for real GDP or real income. These are two different things, but real GDP is how much stuff is produced in your economy. If your economy produces a lot of stuff, your demand for money to buy all of those goods will increase. Real income is about the value of the money that you own. And of course, this is an aggregate economy-wide model. So if a nation gets richer and more people have more income and their income goes further, they're going to demand more cash because they want to pay more for more stuff. But if a country's going through tough times, people don't have a lot of income, their money demand decreases because they're less likely to buy goods. T stands for technology. This is your access for ATMs and your ability to use credit card machines and things like that. When there's less technology available to you, you need cash more. But when you have ATMs and credit cards and online shopping and you can pay with your phone, all of those things are increases in technology, and they would decrease your desire to need cash if you can pay with all those other methods. And then I stands for institutional faith. The institutions in question are banks and the government. If you have faith in banks, you trust banks, so you feel like your money is safe, and your desire to take all of your money out of the bank would decrease. Same with the government. We care about our government stability in terms of we have a fiat currency. It's only meaningful because the government says it is. Our government also has FDIC that backs up our banks. So believing that our government is stable makes us feel more comfortable leaving money in the bank. But if we start to doubt the government and our faith decreases, our money demand would go up. Now that we've introduced the money demand shifters, let's go one by one. So A is aggregate price level. This is about all prices in the economy. If everything else was equal, higher prices increase the demand for money. So as APL goes up, money demand goes up. We have a direct relationship. And lower prices reduce the demand for money. So MD would shift left. This actually goes one step further. The demand for money is proportional to the change in price level. So if APL increases 20%, the quantity of money demanded, the change in money demand, is also a 20% change. Because if everything cost you 20% more, wouldn't you need 20% more cash on hand? I think that's a pretty logical connection. If all prices in the economy decreased 5%, then you would need 5% less cash. Your money demand would decrease by 5%. So whatever happens to APL, money demand moves the same direction and the same amount. R in RT stands for two different things, real GDP or real income. Both would shift money demand. As the economy gets stronger, as it grows, we're going to see both an increase in real incomes and real GDP. Real GDP is all about the total quantity of goods and services produced in an economy. So some economies, like America, for example, we make a lot of stuff. Think of all of the options out there in America that you can buy. There's stuff for sale everywhere you go. Endless choices. So that high real GDP is going to impact your demand for money. When there's things to buy everywhere, your money demand increases. Now imagine if we were in a communist nation where the amount of choices and options for you to purchase would be much more limited. With a decline in real GDP, your money demand would also decrease because you wouldn't desire as much cash because you probably wouldn't make as many purchases. Real income is about how far does your paycheck go. As countries get wealthier, people buy more stuff. They have more disposable income. They feel more comfortable shopping more often, buying fast food, buying that Starbucks coffee, etc. So with higher real incomes, you'll also see an increase in money demand. If a nation was going through a downturn, a depression, or a recession, you might see declines in real income. People might not spend as much money, and therefore their money demand would decrease. So even though real GDP and real income are different things, they both go up when the economy is good and they go down when the economy isn't, and they both have a direct relationship with money demand. If either one of these things increase, money demand would shift to the right. The T shifter in RT is technology. And this is our first inverse relationship shifter. With more technology, you don't need cash as much. If there are ATMs everywhere, you don't need to have as much cash in your wallet. If you can use your phone to pay, if all of the cash registers will take your credit card, if you can do online shopping, all of these things are technological advances that allow you to pay with things other than a dollar bill. So more technology, your money demand decreases. But the opposite is also true. If you know you're going to go to a place that only takes cash, or just a place that doesn't have a lot of ATMs available, then you might desire more cash because there's less access to technology. Or, same thing applies where people are expecting a big snowstorm and power might go out, or there might just not be access to getting to money as quickly. So if people anticipate a decline in technology, they might withdraw more money, their money demand would go up to make up for that lack of access to technology. So the amount of technology and your money demand are opposites. They have an inverse relationship. The last shifter for money demand is I, institutional faith. Your faith in these two major institutions, and we're going to include banks or the government. This is also an inverse relationship. We have a lot of regulations in place to make people trust banks. You have faith in that financial institution. You trust it. And the more you trust the bank, the more comfortable you feel with your money in the bank, and the less you need to take out all of your cash. But if a country's political or banking system were considered unstable, people are going to take their money out of the bank. So if you're afraid of banking systems collapse, if you're afraid of the government having some sort of issue that would not protect your money, People are going to want to take their money out and keep it themselves. They're going to start hoarding their money. So if your faith in these institutions falls, your desire for money in your possession, holding onto cash, increases. Inverse relationship. Now that we've seen the shifters for money demand, you're probably wondering about the money supply shifters. You've actually already learned them. The 3 tools of monetary policy that we learned and were quizzed on in Module 27 are the money supply shifters. So think back, what are the 3 things the Federal Reserve can do? We have the reserve requirement, we have the discount rate, and that includes the spread between the discount rate and the federal funds rate. And then we have open market operations, buying and selling treasury bonds from commercial banks. So if you remember the money market model, the price of money is the nominal interest rate. But we saw earlier that the nominal interest rate is the lowest interest rate in the economy, and it's always the same as the federal funds rate. So the Federal Reserve controls money supply because they're not profit oriented, it's always a vertical line. And where that intersects with money demand is that target nominal interest rate or target federal funds rate that the Federal Reserve is trying to achieve. So if they wanted the interest rates to go up, they could shift money supply to the left. That would raise interest rates. Maybe they're trying to hit a higher federal funds rate. So they're going to use those 3 tools in order to shift money supply. We know that the Federal Reserve controls the money supply, and that the Federal Reserve is a non-for-profit corporation. They do not have any incentive to make more money. All they care about is what's good for the overall economy. So even though the price of money is the nominal interest rate, the Federal Reserve doesn't care about paying the interest rate. They care about raising or lowering the interest rate based on getting us out of a recession or getting us out of an inflationary time period. They don't care about the price. So money supply will always be vertical. There's no profit incentive, and anytime the supplier is not motivated by profit, you'll always see a vertical supply curve. The liquidity preference model of the interest rate tells us that the nominal interest rate, whatever that percent is, we will know because we'll see where the money supply and money demand intersect. That'll give us the nominal interest rate. It's important to realize that the money market model is also called the liquidity preference model. Because remember, money, cash is liquidity. Your demand for money is, do you prefer money in the bank or do you prefer money in your wallet? So just be aware that money market and liquidity preference are the exact same thing. So if you're asked on a multiple choice question about something, or if you're asked to draw one, you're aware that those are the same model. Also, I want you to see that the quantity of money, we have the quantity axes here, and M, let's see, this says M, is the amount of money that we had. So we have the interest rate, I%, we have M as the quantity, we have the price of nominal interest rate, and the quantity is just quantity of money. So all those things are now fully labeled. To review, we know the Federal Reserve is in charge of money supply, and they change money supply in order to achieve whatever their goal is, their target rate for the federal funds market. So if they're trying to make the federal funds rate decrease, then they want the nominal interest rate to decrease too. The 3 ways are their 3 tools. They can buy or sell treasury bills in open market operations. So let's go ahead and see how this would work. in order to fully label, we have the nominal interest rate, we have equilibrium, money supply, money demand, the quantity of money you can shorten to QM or Q $sign. Both are totally fine. Where the money supply meets that quantity, we can call M. And the interest rate at equilibrium is I. All right, so if our goal is to decrease the money supply, decrease the nominal interest rate, money supply would need to increase. So we have MS2, arrow, E2, M2, arrow, and I2, arrow. Remember, we only do arrows on the outside of models, not in the middle. So let's see how all three of these federal tools, the goal is, what are we going to do to increase money supply? So the first one, the Fed can buy or sell treasury bills in open market operations. Buying equals bigging. So if we buy more T-bonds, that gives excess reserves to those commercial banks. Commercial banks can use that excess reserves to loan out money. That will create more money. The money supply can increase. If we want to use the discount window, then, and our goal is to have money supply increase, then we want to have the total amount of loans increase. So we would reduce the spread. Remember, spread is the difference between the discount window and the federal funds rate. If the spread is decreased, then that means that the worst case scenario, the most expensive thing that you have to pay if you're short on funds just went down. Banks will loan out more money. Money supply will increase. And then finally, for reserve requirements, if our goal is increasing money supply, we want more loans. So we could decrease reserve requirements. So banks are not required to hold as much in reserves. That will allow more loans, increase in money supply. Let's look at some practice problems using a money market model. First of all, I'm going to go ahead and fix this. The interest rate should be nominal interest rate. And we need to have an equilibrium. And now we're fully labeled. There we go, much better. All right, first question. If the interest rate was I1, right here, what is the difference between money supply and money demand? So if you trace this I1 line out, we can see that we hit money demand before we hit money supply. So money supply has a bigger quantity than money demand. If you have more supply than demand, you have a surplus. If the interest rate was I1, would CDs or cash be a better choice? And remember, we're talking about CDs being certificate of deposit. Well, in this case, CDs would be a better choice because the interest rate is higher than the equilibrium interest. So you're earning more money than you would be normally. Now, if there's a surplus of money, that means that there's more money being supplied by the Federal Reserve than is being demanded by consumers. If banks realize interest rate is high and that the demand for CDs is very high as well because of the high interest rate, they can lower the interest rate a little bit and still attract customers because banks have to pay interest for people that are holding on to these CDs. And if they're paying more interest than they want to pay because the demand for CDs is so high, they're probably realizing that they're throwing money away. So they're going to lower the price. If you lower the interest rates, it's going to bring it back to equilibrium, this I star. Remember, all models always return to equilibrium. Here we're seeing shortages and surpluses in a new model, but it works the same way. If the interest rate is too high, that's the same thing as the price being too high. And the economy is naturally going to lower it until it now reaches an equilibrium where you no longer have a surplus or a shortage. All right, yet again, let's make this properly labeled. We have the nominal interest rate and equilibrium. You might have noticed that there's an M star. That is just like saying M at equilibrium, and the I star could be I at equilibrium, and those would be just fine too if you don't like the stars. All right, so currently the economy is at I2. So what is the difference between money supply and money demand? Well, if you trace M2 out, we're going to hit money supply before we hit money demand. So if demand is greater than supply, you have a shortage. So we have a shortage of money, we have low interest rates. If interest rates are low, lower than equilibrium, would CDs or cash be a better choice? Cash would be. Why would I want to buy or put my money, lock my money into a CD when interest rates are so low? If interest rates are low, banks will realize, look, I need customers to get CDs. Banks like CDs because they know that if you bought a 12-month CD, then you're not going to take your money out for 12 whole months. So banks can actually use that money to loan it out, and they know that that money isn't going to be touched. For that reason, because CDs are so illiquid, the reserve requirement on CDs is much lower. So they want you to come on in, lock in on a CD, and they can use your money. But with it low interest rates, they need customers. To encourage people to put money into a CD, they're going to raise interest rates to bring in customers. That will get rid of the shortage of cash because instead of everybody demanding cash, now the money supply will equal the money demand. So what will this do to equilibrium? This really should say, what will this do to interest rates? And the answer is return them to equilibrium. Next, we're going to use the model we just learned, money market or liquidity preference model, to connect it to other economic models. The first one will be new. It's called demand for investment, and thankfully it's very simple. Investment is all about investment spending. As interest rates fall, businesses invest more in capital equipment. Capital equipment, we can see in this picture, are pieces of tool, machinery, computers, and if they're going to have to finance this, when interest rates are low, it's a great time for businesses to spend this money if they have to put it onto their credit card or take out a loan to buy it. As interest rates rise, businesses invest less in capital equipment because their payments are going to cost more if they have to pay interest. They will replace things that are broken, but they're not going to buy as much new capital equipment when interest rates are high. So, nominal interest rate on the money market model is going to match the interest rate on the investment demand model because when nominal interest rates fall, they push down other rates. Remember, all interest rates go up and down together. So nominal interest rates, the lowest ones, but if they go up, all the rates above them go up. If they go down, all the rates above them also go down. Here we can see the investment demand model. It is just this simple. Investment demand only has a demand curve because it's all about businesses' desire to spend money on capital equipment, on investments. So the demand curve, like all demand curves, are downward sloping. The quantity is quantity of investments. The interest rate is the real interest rate, because if a business is going to finance the spending, they're probably going to take out a loan. Those loans could be in a few years, and you will notice the effect of inflation. So loans, the price of loans is always in the real interest rate. So here's the order of these models. We're going to start with the money market model. That affects investment demand. So interest rates, nominal interest rates go up or down in the money market. When nominal interest rates go up or down, that's going to affect investment demand. And investment demand, investment spending, is part of GDP. If you remember, the AD shifters, aggregate demand, our GDP grew. So if consumer spending or investment spending or government spending, if any of those things increase, AD shifts right. So this is all about investment spending, the big I, and that's why it's going to impact aggregate demand. So we're going to see all three models and how they fit together. The whole point of monetary policy is to use it to fix problems in our economy, to get us out of recessionary or inflationary periods. So here we're starting with a recession. We want to fight a recession. Looking at the picture, you can already see that money supply increases. So what is the Fed going to do? Are they going to buy or sell bonds to increase money supply? They're going to buy bonds. If they buy bonds, the quantity of excess reserves that banks have will increase, because when the Fed buys bonds from commercial banks, they pay them with excess reserves. When banks have more excess reserves at their disposal, they're able to loan out more money. That will multiply and money supply will increase. So all of those things are shown on the model that we see. So you definitely want to be able to draw this and label all of the pieces. We can see how money supply has shifted right, and when it does, the nominal interest rate decreases. That's going to lead us to the investment demand model. So even though money market is in nominal interest rates and investment demand is in real interest rates, when interest rates go down, nominal rates go down, that's going to push all interest rates down. So on the investment demand model, it's always a move along the curve. When real interest rates fall, you can see that the quantity of investment demand moves along to the right. So the quantity of investment demand increases. And if you think it through, this makes sense. When interest rates are down, businesses know this is a great time to finance that new endeavor. I'm going to take out a loan. I'm going to buy that capital investment. Investment demand is all about investment spending. So when interest rates are down, consumer and investment spending increases. That's going to shift AD. It will shift AD to the right. Now, before we draw the AD-AS model, it's important to look back at the top here. We started with a recession, which means when you draw the model, E1 should be a recessionary gap. So you can see that it's starting over to the left of long run. It's less than our potential. So we're currently over here in the recession, but when investment spending goes up, because the quantity of investment demand increases, AD shifts to the right, it gets us out of the recession. While you're drawing, one more thing I want to show you. Something always goes together. Whatever happens to money supply also happens to AD. So money supply increased, eventually AD will increase too. More money leads to more spending. Of course, you can see there's all kinds of steps in between, but if you're just double checking your work, if MS shifts right, AD better shift right as well, or else something went wrong. So go ahead and pause if you need to keep drawing this, to keep labeling all the pieces. Now let's see how monetary policy can be used to get us out of an inflationary period. Here I have all three models to begin. Now, the money market model doesn't actually show inflations or recessions. It just starts at equilibrium and then it moves. The only model that actually has gaps is the ADAS model. So you can see that that one is already drawn to show we have an inflationary gap. Okay, so you can also do this backwards. You can think, all right, I have an inflationary gap. So my goal, if I'm going to use these things, is to make AD move back to the left. And if AD needs to move back to the left, and AD and MS go the same way, I need to decrease money supply. So you can think this through different ways. So if we're trying to decrease money supply, would the Federal Reserve buy or sell T-bonds? It would sell them. So if they sell Treasury bonds, that means that they're selling bonds to commercial banks, so the quantity of excess reserves that those commercial banks have decreases because they have to pay the Federal Reserve for those bonds with their excess reserves. If banks have fewer excess reserves, they can issue fewer loans, so money supply will decrease. That's a left shift. So to finish labeling, we have MS2, you would have M2 with an arrow, E2, and I2. When that's all drawn, you can see the effect on the nominal interest rate. So the nominal interest rate increased. Money supply and interest rates are inverse, so far we're doing well. When nominal interest rates increase, that's also going to mean that real interest rates increase. So we're going to have a move along the curve of investment demand. So the investment demand will move along the curve to the left. We have an I and an I2 because we can see that all interest rates are going up and down together. When interest rates rise and the quantity of investment demand moves along to the left, that means it decreases because businesses will realize this is not a great time to finance their spending. If investment demand decreases, that means investment spending decreases, and that will shift AD to the left. So we have one more model to finish labeling. AD would shift to the left. You would have an AD2, E2. And quick review, are we going to have a YP2 or YE2? YP stands for potential. Our potential hasn't changed, but our equilibrium output has. So we're going to have a YE2 with an arrow, and then finally a PE2. So we can check to see that certain things are lining up. If money supply decreases, AD should decrease as well. Check. If your interest rates are increasing on one model, they should increase on the other model. Also true. And this contractionary monetary policy did get us out of the inflationary gap. Now we're back to our potential.